And welcome to Inside India. I'm JP Ong, and here are your headlines. The Nifty reclaims its 26,000 level, with the latest inflation data keeping expectations for further rate cuts in play. But uncertainty over a U.S. trade deal could still weigh on sentiment. JP Morgan, though, is expecting a lot more upside for the Nifty in 2026, and we'll hear from them coming up in the show. Hopes are dimming for India to conclude a trade deal with the European Union by the end of this year. Reports indicating steel and autos are holding up talks. And Indian Prime Minister Narendra Modi looks to bolster trade ties in the Gulf, kicking off a visit to Jordan, his first to that Middle East country. Good morning and welcome to the show. We start off once again with a look at how Asian markets might be setting the tone ahead of this new trading week. And it's looking like a moody Monday for major equity indices from Shanghai to Sydney. We're seeing a lot of stocks actually pulling back in a week where a lot of monetary policy decisions will be made by central banks across the world, including the Bank of Japan, the European Union, and the Bank of England. Japanese equities down also on expectations that maybe there will be a rate hike in play this coming Friday, and growing expectations that the BOJ indeed will tighten policy amid signs of a higher inflation and perhaps an economic recovery. That stronger yen weighing on stocks out in Tokyo. Meanwhile, another thing really weighing on sentiment across mainland China, worse than expected industrial output and retail sales data really stymieing the mood, with the Hang Seng Index down by about 0.7%. Property stocks again in focus after China Vanke, one of the biggest developers in China, also getting a rejection on their request for an extension on some of their bond payments, raising more debt questions with regards to the property sector in China as a whole. And the Indian markets will be set to come online in about 43 minutes. And here's what Gift Nifty futures are now indicating ahead of this fresh trading week out in Mumbai. And we're seeing the Gift Nifty futures are foreshadowing at least a slight gain after 3 days after they breached that 26,000 level. It seems that they might extend that by just this much. The yen rupee also in focus after steadying today, but still relatively weak and near those record week levels at 90.56 against the U.S. dollar. Meantime, reports suggest that the India-EU trade deal is unlikely to be concluded by the end of this year. And that's despite repeated rounds of negotiations and public commitments from both sides to wrap up talks in 2025. Sources tell Bloomberg that discussions remain stuck on key issues, including automobiles and steel. Talks may now extend into January, with both sides hoping to announce a scaled-down agreement during a planned visit to New Delhi by European Commission President Ursula von der Leyen. The EU is pushing for a higher quota for car exports to India at reduced tariffs, while New Delhi is seeking relief on steel duties and flexibility around the bloc's carbon tax rules. The talks have taken on added urgency as India looks to diversify trade ties amid higher U.S. tariffs. Meantime, Prime Minister Modi is embarking on a 4-day foreign tour as we speak. Modi will visit 3 countries and kick off the tour with Jordan to strengthen ties across trade and defense. He will then travel to Ethiopia for his first ever visit, holding talks with Prime Minister Abiy Ahmed, focusing on boosting cooperation as partners in the global south. The final leg takes him to Oman, where New Delhi and Muscat are expected to seal a free trade agreement. Meantime, on the macro front, retail inflation rose to 0.71% in November from a record low of 0.25% in October, but remained below the Reserve Bank of India's target for the 3rd straight month. Slower food prices declines, including a 22% drop in vegetable costs, contributed to the uptick, while core inflation stayed elevated at about 4.2 to 4.3% because of firmer gold prices. The November inflation print fueling hopes of another 25 basis point cut by the RBI, potentially during its next meeting in February. India will update its inflation index with a new base year from February 2026, lowering food weight and raising non-food components. Currently, food and beverages have a weight of about 46% on the index. We're joined now by Sunal Varma, the chief economist for India and Asia ex-Japan at Nomura, to help us understand what these inflationary trends might be foreshadowing or perhaps telling us about the fast-growing Indian economy. Sunal, thank you so much for joining us today. Inflation, again, showed signs of picking up, albeit still fairly muted overall. Talk to us about if Nomura is expecting this to be the start of a reflationary trend in India and what the pace of that reflation might be if indeed that is the case.
Hi, JP. I mean, inflation has surely bottomed out, so the year-over-year numbers will pick up going forward. But I wouldn't call it a reflationary trend. I think over the next 12 months, our view is inflation is going to stay benign. And for 2026, we think it's going to be a second consecutive year where inflation undershoots the RBI's 4% target. So it's fairly benign. Now, if you break inflation up, we are seeing the adverse base effects on food starting to unwind. So the pickup in headline inflation is largely because of food deflation gradually easing off. But the bulk of the inflation in India currently is actually driven by gold prices. I mean, gold inflation is running at over 50%, and that's contributing almost 60 basis points to headline inflation. So if you actually strip out gold, then headline inflation is just above 0% right now. We look at what is called the super core measure, which is excluding some of these commodity because they don't really give us any input or insight into demand side inflation. And that measure on a 3-month basis is actually running at 1.5%. Our trim mean measure is at 2.5%. So we think it's benign, and there are a mix of both soft demand, soft supply side pressures, including low commodity input costs, and some structural disinflation that's ongoing in India. So we see the benign inflation as being more durable, even though the YOY rates will move up.
Okay. One thing that's also been noted is that generally this soft inflationary trend that we're seeing in India might actually be supporting the economy in some ways by giving more spending power to the very important consumer sector. Can you walk us through whether or not that is a reliable framework or dynamic when we're looking at the Indian economy right now? And is the soft inflation actually becoming more of a boost than a bane for the Indian economic outlook?
I mean, I think it is a boon for the Indian economy. It works through two primary channels. One, food is a large part of the consumption basket for many of the households, particularly the middle-income households. So this period of benign food inflation is leading to an increase in real disposable income. So some of the recovery we've seen in, for instance, rural consumption, in our view, reflects this pickup in real disposable income of the food-consuming rural households. So that's one channel. Second, this low inflation is also because globally commodity input costs are low. So from firms' perspective, their profitability is actually rising even as there's a pressure on their top line growth because of lower headline inflation. So profitability, of course, of companies, companies can decide to save or they can decide to invest, but that's also boosting profitability. So yes, we do think benign inflation is a boon. Now, India is a 4% inflation economy, and if you have very low food prices for too long, then it can also become a negative for some of the food producing households in rural India. So we need the right balance on inflation.
Okay, so now just quickly, we're going to take a quick pause, but do stay with us because we're getting some key commentary now from Anthony Albanese, the Prime Minister of Australia, with regards to likely to the recent tragic attack over the weekend. Here's what the Prime Minister is saying right now.
Just a couple of years ago, it is a historic place. And the fact that this was a venue for this act of evil that was clearly calculated by these perpetrators is just an outrage and has shocked the community. One of the things that is coming through, though, is that the community want to be able to express their support and solidarity. And I would urge and join with others who have urged Australians across the country to light a candle, put it in their front window tonight at 6:47 p.m. to show that light will indeed defeat darkness, part of what Hanukkah celebrates, of course. We are stronger than the cowards who did this. And I want to conclude finally by saying that the government is prepared to take whatever action is necessary. Included in that is the need for tougher gun laws. And this afternoon at 4 o'clock I will put on the agenda of the National Cabinet tougher gun laws, including limits on the number of guns that can be used or licensed by individuals. A review of licences over a period of time. People's circumstances change. People can be radicalised over a period of time. Licences should not be in perpetuity. And checks, of course, making sure that those checks and balances are in place as well. We will I'll take to National Cabinet this afternoon a proposal to empower agencies to examine what can be done in this area. Quite clearly, the Howard government's gun laws have made an enormous difference in Australia and are a proud moment of reform, quite rightly, achieved across the Parliament with bipartisan support. If we need to toughen these up, if there's anything we can do, I'm certainly up for it, and I hope to get National Cabinet on board for that this afternoon as well. I'll ask the Minister to make some comments, and then the Acting Deputy Commissioner, Nigel Ryan, to make some comments as well.
Thanks, Prime Minister. Yesterday,
that's Prime Minister Anthony Albanese of Australia talking about the recent tragic Bondi Beach shooting and Australia's own moves to try and tighten gun laws even further and gun restrictions to make sure that in an effort to prevent such tragedies and attacks from happening again. We're joined once again by Sonal Varma, Chief Economist for India and Asia ex-Japan at Nomura, to talk once again about the Indian economy. Sonal, let's change track once again to some of these things. And again, when we talk about the Indian economy, we have to talk about some of the geopolitical uncertainties or external uncertainties, chief among them this U.S.-India trade deal. Now, while it seems that Prime Minister Narendra Modi held another warm phone call with U.S. President Donald Trump, it seems that we might not see a trade deal happen anytime soon, definitely possibly not by the end of this year, and maybe deeper into 2026. If this continues to drag, how much of a headwind might this pose for the outlook of the Indian economy if a trade deal seems to get kicked further and further down the road?
Yeah, JP, I think it would have an impact because some of the labor-intensive exporting communities, textiles, toys, furniture, I mean, they've already seen significant order cancellations, and therefore the impact on them in terms of cash flow revenue will be seen. Now, in terms of the aggregate impact, though, we think it is manageable because the government is currently negotiating FTAs with many other countries. And in some sectors, for instance, like marine products, we've already seen diversification help support exports. So for some of the other export categories, we do think diversification will help through the course of 2026. Our baseline is that a US trade deal is still likely. But, in the scenario where it does not happen, we would still think GDP growth in 2026 should be close to 7%, because one thing we've seen this year has been substantial policy easing, whether it's fiscal easing, credit macroprudential easing, RBI's policy easing, liquidity easing. So we think cyclically domestic demand in India can still pick up and offset some of the drag because of the US tariffs.
And just very quickly, Sonal, I do want to get your thoughts on where you see the rupee perhaps heading next year, especially after it crossed 90 to the US dollar, and with expectations that the RBI might be a bit gradual with their easing in 2026. What's Nomura's call with regards to where the currency might be middle and end of next year?
Yeah, sure. So, I mean, our view is in the very near term, the pressure on INR towards depreciation will continue because the trade deal still remains elusive, and we've seen portfolio outflows on the equity side continue. So we are expecting dollar INR to depreciate towards 92 by March of 2026. But as we look out through 2026, we do think the current account deficit is fairly stable at 1% of GDP. And if you're right and the cyclical domestic indicators start to turn up, then equity inflows should come back. And there's also potential for bond index inclusion for India next year, which can also bring in more portfolio debt inflows next year. So by end of 2026, we think INR could be closer to 90, mainly because we think RBI will step in and rebuild its FX reserves as inflows pick up.
So perhaps 90 becomes the new anchor for the local currency. We'll have to leave it there. Sonal Varma, Chief Economist for India and Asia ex-Japan at Nomura, we thank you for spending some time with us on Inside India to share your thoughts and the group's outlook with regards to the Indian economy and all things related to its macro landscape. Now, we're on central bank watch this week. The yen, as we count down to the BOJ decision later on this Friday, currently looking quite strong, perhaps playing a part in why Japanese equities are taking a step back this Monday. Now, we are seeing it trade at around 155.37 against the U.S. dollar, with expectations the BOJ indeed will introduce that rate hike this coming Friday. Its path moving forward is something that's up for debate, though, with signs again of perhaps just some fragility with regards to the Japanese economic recovery. JGB is also worth looking at in today's session. And ahead of that decision, we do have that December Tankan survey that showed big manufacturing sentiment from big manufacturers rising to a 4-year high, bolstering expectations for the Bank of Japan to hike rates this week. As we wait for those yields to come up, there you go. You're seeing 10-year yields inching higher and closing in on 2% at the moment with regards to that tenor. But the 2-year going the other way and weakening, are just easing off to about 1.068%. Perhaps a sign that the yield curve in Japan is indeed steepening ahead of the expectations for the BOJ to hike rates this week. Now, it's the third quarter that index with regards to large manufacturer confidence has improved, but businesses still overall expect conditions to worsen over the next quarter because of the continued tariff uncertainty. We'll also be getting decisions from a myriad of other central banks across the world, from the Bank of England and the European Central Bank later on this week. The Bank of England is expected to cut rates in a close decision out in London, as inflation is expected to edge lower. Key to watch will be UK inflation data on Wednesday ahead of the decision. The ECB, meanwhile, is likely to hold steady, with markets eyeing the post-decision commentary for where rates could be heading in 2026. And closer to home here in Asia, apart from Japan, Taiwan's central bank also expected to hold steady as growth has held up, while Indonesia's central bank expected to lower rates to bolster growth. We're also bracing for a whole raft of U.S. macro data this week, giving us a better read on how the world's largest economy might be faring after the 43-day-long government shutdown. The jobs report for November is due on Tuesday, with economists expecting 50,000 jobs added to payrolls and that the unemployment rate will stand at 4.5%, rising from 4.4% in the month of September. We'll also be getting November CPI due on Thursday and the core PCE reading, which is the Federal Reserve's preferred gauge for inflation, due this coming Thursday. Chicago Federal Reserve President Austin Goolsbee sat down with CNBC's Steve Leisman and explained why he voted against last week's Fed rate cut.
I'm pretty optimistic that for 2026, rates will be able to be a fair bit lower than they are today. But I've just been uncomfortable front-loading too many rate cuts and assuming that what we've seen in inflation be transitory. It's all amplified by the data being shut down. And so I just felt that we ought to wait, that we don't lose a lot, we don't take a lot of extra risk, in my view, to just wait to Q1 2026 and make sure that we're back on path to 2% inflation.
Now, before we take a break, you might have noticed that our local logo, looks a little different today. And that's because CNBC has introduced an updated design, which reflects a refreshed look for our network as we continue to bring you the business and financial news you rely on. We'll be back in 2 minutes with more of Inside India. Don't go away. Welcome back. A Hong Kong court has found businessman Jimmy Lai guilty of sedition in a landmark national security trial. Just a few minutes back. Now we have Elaine Yu, who's live on the ground keeping track of the story. Elaine, tell us what's the latest now with regard to this verdict.
Hey, JP. So a panel of 3 government-appointed judges have found Jimmy Lai, the pro-democracy media mogul and staunch critic of the Chinese Communist Party, guilty of all 3 charges. 2 counts of foreign collusion, which is a crime created 5 years ago by the national security law, and also 1 separate charge of sedition. And his lawyers have said that they have not yet decided if they will appeal the verdict, but we will get the sentencing on a later day. The mitigation hearing will take place on January the 12th next year. Now, the judges say that there is, quote, indisputable evidence that he worked with others to undermine national security, saying that the articles on Apple Daily and others that he's written that were being looked at by the court were, quote, objectively seditious, and that they were written to bring hatred and contempt to the Hong Kong government and to excite disaffection against it. This is according to an 850-page long judgment that was just released. And the judge also said that his campaign lobbying foreign governments to sanction officials over their political crackdown in Hong Kong has not ceased since the enactment of the national security law. Some of the messages that they cited of him trying to arrange meetings with U.S. officials were dated before the law, but the judge said that he continued with this action while he was aware of the legal risks. And here we're surrounded by heavy security presence, as well as members of the public who have lined up overnight to try to get into the courtroom. And earlier we also saw a number of former prominent democracy advocates who attended the hearing, including 93-year-old Cardinal Joseph Sen, the retired cardinal, accompanying his wife, and also pro-democracy former lawmaker Emily Lau as well. So this is closely watched as well by the international community. JP?
Yeah, Elaine, so now that we have a verdict's been delivered, when can we expect the possible sentencing of Jimmy Lai?
The sentencing will take place after January the 12th, depending on how long the mitigation arguments take place. And although this verdict was very much expected, still foreign governments have raised concerns. They have talked about called for Jimmy Lai's release. The U.S. government and President Trump has reportedly raised this issue with President Xi when they met in late October in South Korea. And Jimmy Lai, he was born in mainland China, flat as a boy, but he is now a UK national, and the UK government has also called for his release and pressed for consular access to him, and also pressed for an independent medical assessment of his health. Now, the business community is also paying attention, although they haven't been as vocal on this, especially since the national security crackdown. And some members of the community tell me that the judicial standards for commercial cases have not really been impacted by the political crackdown, but still there are broader concerns about the environment. Let's take a listen what senior fellow of Harvard Kennedy School Andrew Collier said earlier on CNBC.
So this has kind of been expected with Jimmy Lai. They obviously were targeting him, so I'm not surprised at the verdict. However, it's kind of another nail in the coffin for this. The question is, for Hong Kong's future, whether there's enough capital from the mainland and U.S. dollar owned by Chinese investors to allow the banks to flourish. And this year they've had a pretty good year because the IPOs have been up and so forth, so it's been relatively strong. But long term, if investors are not comfortable with the court system, with cases like Jimmy Lai's, that's not good for the future of Hong Kong.
Now, the advocacy group Reporters Without Borders have responded to the verdict, saying that it is not an individual who was on trial today, but press freedom itself. And they added that the verdict, with this verdict, that has been shattered now. But Beijing's foreign ministry has also said that safeguarding national sovereignty and security is the highest principle of one country and two systems. And they also said that the central government firmly supports the Hong Kong government in upholding upholding national security and punishing acts that endanger it. JP.
Elaine, you in Hong Kong with those very important and vital updates with regards to the case facing Jimmy Lai, who has now been found by verdict guilty of sedition. Meantime, authorities say they have detained a person of interest in connection with the Brown University shooting on Saturday that killed 2 students and left 9 injured. According to Providence Police, the person is believed to be in their 20s. Investigations are ongoing. The Ivy League university has canceled classes and exams for the rest of the year. The Brown University attack comes nearly 13 years to the date since the Sandy Hook mass shooting in Connecticut, one of the deadliest school shootings in U.S. history. And tensions between Thailand and Cambodia continue to escalate. Thailand's military is now considering blocking fuel exports to Cambodia, with the fighting now spreading to coastal areas of a disputed region. Thai authorities have imposed a curfew in the southeastern Trat province 2 days after Trump spoke to both the Thai and Cambodian prime ministers, saying both sides had agreed to cease all shooting, a claim which Thailand's prime minister later disputed. Well, coming up, the Nifty has recovered a bit in the second half of the year, reclaiming that 26,000 mark. Now, but uncertainty over a U.S. trade deal could still weigh on sentiment. JP Morgan, though, is expecting a lot more upside for the Nifty in 2026. And we'll hear more from them after this short break. Welcome back. Data out of China this morning showed more weakness in the month of November. Emily Tan joins us now with the latest on what I assume is the trifecta of data that just crossed with regards to industrial output, asset investment, and retail sales. Emily, what can you tell us with regards to how weak it got?
We're looking at a momentum slowing in a Chinese economy. The latest numbers to come through for the month of November, JP, just about an hour and a half ago, showing that retail sales we're looking at the lowest level since 2022. This is a rise of 1.3%, coming in weaker than expected, and against the rise of 2.9% in the previous month of October. Industrial production was also coming in a little bit weaker than expected, up 4.8%, and against 4.9% rise in the previous month. Fixed asset investments for the first 11 months of this year declining 2.6%, and that is tracking lower than the 1.7% pullback that we saw in the previous month. Some data, or I should say some lines that came through from the Statistics Bureau accompanied with the numbers. China's economy stabilized while improving in November, it says. The impact of changes in the external environment have deepened, and it went on to say that conflict between strong domestic supply and weak demand is prominent. Also, that some industries and firms are facing difficulties. China's top leaders in the latest Central Economic Work Conference has pledged to give top priority in supporting domestic demand. We know that that has been slated as one of the priorities for the next 15 five-year plan, and we'll get more from the Chinese government when it comes to their full-year growth forecast at the National People's Congress when they convene their annual meeting in March. But wide expectations are for that figure to come in at around 5%, which is what we had the figure come in for this year. And after all the data that has come through, a particularly strong third quarter and export numbers have come through, which has prompted and lifted the economic growth numbers for China this year. We heard from a number of different brokerages, including Bank of America just today, B of A, raising their full-year growth target for China this year. They're expecting a rise of 5%, which would be in line with the government's own forecast. So we got a whole slug of economic numbers this morning, JP, all coming in a touch softer than expected. Back to you for now.
And key there, Emily, will be whether or not these signs of softness will guide policy for Chinese regulators and policymakers in the year ahead as well. Emily, thank you so much for those very crucial updates on the world's second largest economy. Back in India, the government has approved major reforms to its nuclear energy and insurance sectors, aiming to attract billions of dollars in foreign investment. In nuclear power, the government will ease long-standing restrictions to allow private and foreign participation as India targets a 12-fold expansion in capacity to 100 gigawatts by 2047 in an effort to cut coal use and meet climate goals. Separately, India plans to fully open its insurance sector to foreign investors, removing the current 74% cap. Though companies will still need Indian leadership at the top, both proposals will be taken up in Parliament during the winter session. Speaking of the insurance sector, digital insurer ACO has begun early preparations for an IPO, aiming to raise between $300 and $400 million, according to reports. The General Atlantic-backed company is in preliminary talks with investment bankers, with formal pitches expected in January and a potential listed targeted for 2026 or in 2027. The IPO is likely to include a mix of fresh capital and secondary share sales by early investors. As India's IPO market stays red hot, ACO's move underscores growing investor appetite for digital and tech-focused companies. We are counting down to the market open out in India, about 11 minutes away, actually, and a final look at what Gift Nifty futures are foreshadowing. And it seems that the breach of 26,000 might hold, only by so much, though. 26,060 is the implied open, just slightly above the 26,047 level, where the Nifty 50 ended last Friday. The Indian rupee also looking just a little bit firmer, but again, not by much. 90.56 against the US dollar. And again, the rupee looking at risk of, again, hitting new weak record levels against the greenback. Overall, though, this seems to be doing little to actually cloud the outlook from JP Morgan with regards to where Indian equities might be heading. In fact, it is a rather rosy outlook. We're joined now by Rajiv Batra, who's the head of Asia Equity Strategy and co-head of Global EM Equity Strategy at JP Morgan. To talk about why they're quite upbeat with regards to where Indian equities and markets might be heading in the year ahead. Rajiv, as always, thank you for joining us today. Let's get into it then. It seems that JP Morgan seems quite hopeful in Indian equities next year, but just how hopeful? Walk us through the bull case, if I may call it that, and whether or not JP Morgan has strong targets, at least, for the Nifty 50 and the Sensex, if possible.
I think before, JP, we start with the bull case, which is almost a 33,000 for Nifty and a Goldilocks kind of a scenario. It's important to go what's there in the base case. And the most important part of the base case is the worst on earnings downgrade cycle is behind us. We saw some signs of it during the September quarter result, where we got close to 9% bottom line growth overall from MSCI India, surprising to most of the sell side over there. Now we are moving into a cycle where next 4 to 6 quarters you will be getting early double-digit kind of an earning growth number and potentially even a surprise like ongoing quarter. And that leads to you towards almost 14 to 15% upside on a base case. In a bull case, you require a trade deal. And that's where the re-rating will click in. And with 15% earning growth plus close to around 14 to 15% re-rating, you get up to the bull case. But bull case require a trade deal between India and US.
So base case at 33,000 at the moment, right?
Base case 30,000.
30,000 for the base case. Okay, I stand corrected there. Again, this is underpinned by an earnings recovery, and you're not the first one in the markets to actually talk about why we're seeing that. Based on what we've seen with regards to the last couple of quarters, what do you think has been driving what some say is the earnings upside surprise with regards to Indian earnings right now, Rajiv?
Definitely, I'll say once bitten, twice shy, but you have been bitten 5 times, like past 5 quarters. There was an anticipation, now we are out of it, but that didn't happen, due to which we can see the sell side estimate going into like this quarter or previous quarter or even next year are quite anemic and low. So that's easily sets a very low bar for you to beat as such. And beyond that, historically we have seen whenever the twin policy is in easing, is in action, growth is always an outcome that will follow up. This time around, maybe it's coming with a quarter or two kind of a lag, but we believe twin policy easing leading to a higher domestic demand is leading to improvement in earnings. And remember, earnings improvement is not just led by one or two sector only. We are seeing it will be a broad-based sectoral growth, particularly that are catering or serving towards the domestic demand.
Okay. Now, some have actually also pointed out that there's also the interesting and perhaps exciting trend that perhaps we're seeing earnings with the mid caps actually outpacing that of the large caps. Do you think that this is a trend? This indeed is a trend that's worth watching in 2026 when it comes to India? And do you think that, and if so, what do you think might be driving perhaps optimism with regards to this particular segment of the Indian market?
What's the key segment of this easing cycle? It's a rate cut. So we have seen close to around 100 and 125 basis point of a rate cut in this cycle. That is reducing the borrowing cost. So if you will look at a leverage, the most amount of a leverage lies with my mid-cap corporates over there. So if you are changing the leverage pattern, like if you are reducing the borrowing cost, which is as a one variable beyond the raw material cost, which is getting lower, that is where they are giving you a surprise. And past 2 consecutive quarters, we got 25% plus kind of an earning growth from mid-size corporates over there. So expect that to continue in the coming quarter also. And we are style agnostic. We believe, be it the large cap, be it the mega cap, or even the mid cap, they will tend to do well. Small cap, there will be some struggle because they are not giving you earnings, whereas valuations are very high in small cap.
So is it more like the input costs coming down, the cost of doing business coming down, which means the margins and theoretically earnings also getting that sustained upside that seems to be surprising even the folks at JP Morgan, for instance?
So last 2 quarters, yes, definitely margins have been a clear driver for mid-cap corporates, and cost of production, be it on the raw materials or interest, was the dynamic. But going forward, we expect the top line should also improve. Even if we are moving from 7.7% nominal growth or 8% nominal growth this year towards 9.5% next year, that still gives us a decent headroom for revenue growth, which usually track your nominal GDP growth of the country.
Okay, Rajiv, let me do this. Let me take a step, take a different view of things and do it in terms of a relative analysis. Now, the folks at UBS don't seem as rosy as JP Morgan. They say it's not that Indian equities are ugly, but I think there are prettier ones out there. I'm talking about markets, that is. Do you think, and what underpins that argument is that there's a lack of tech and AI exposure in India that makes them not as lucrative as some of the others. What are your thoughts on that particular take? And do you think that's something that perhaps holds a little bit of weight when investors are trying to decide whether or not to allocate their portion of EM funds to India versus others in Asia, for instance?
No, that's definitely one of the case behind anemic growth or being a low beta market that India has suffered, because this year either you have to be a high beta market, which we have seen in Latin America or in Central European country, or you need to be an AI driven market, which we have seen in case of North Asia, China, Korea, Taiwan, or even in case of Japan also. India was neither part of it, like ASEAN, nor in, you can say, in AI, or not being a high beta market. India's beta is 0.4.
Is that a good thing or a bad thing?
in a bad times, it's a good thing because it means your returns are much more sustainable, your volatility is low. But when there's an animal spirit, you need to be higher on the beta to maximize your return. But that said and done, if we are getting towards now what you are seeing last 1.5 months, people are worrying about AI cycle. India is appearing as a good AI hedge. And talking about the performance, India last 12 months has underperformed EM by 25%. So you can say that lot amount of not being AI pain has been in the price so far.
So in a dismal scenario, if I can call it that, or a market correction, India will look better compared to everyone else. So are you expecting a correction perhaps in the markets given how high some of these valuations, especially in the tech space, have gotten? And again, do you think that this will be better or a good thing or a bad thing for Indian markets if indeed that correction is coming?
So definitely, momentum as a style, we are seeing some consolidation happening, and we do consider that consolidation will continue in the momentum space. AI was definitely one of them, and JP Morgan strategy team is neutral on AI theme this year along with Taiwan. So we do expect some consolidation happen. In this scenario, people will definitely look at laggard, people will definitely look at domestic demand players, and that's where India fit the bill. Like if you look at growth improving, if you look at margins getting better, if you look at valuation, not cheaper, but relative to EM has got attractive. Issuance is the only problem India is facing right now. But beyond that, other three boxes India is checking. And if growth makes a comeback, India again becomes a sustainable story for my foreign investor.
Okay, so let's go back to what you outlined as the possible bull case. And you said what's necessary for the bull case to happen is a U.S.-India trade deal. But based on what we've seen so far, it seems that the can's getting kicked further down the road. They both keep on saying that we're close, we're close. Doesn't seem to be happening this year and maybe deeper into next year. If this prolongs, what does this do in terms of possible headwinds for the outlook with regards to equities? Or do markets even care about this? Because right now we're seeing that domestic consumption seems to be doing a lot of the heavy lifting for India's economic and market outlook.
So if any kind of a trade deal or a truce happen or relationship get fully normalized over there, definitely re-rating will be back on the tables. So if you look at again emerging market performance this year, 75% of a return for emerging markets or even global market could be explained through valuation re-rating. India has seen valuation de-rating because India's relationship US was not that great enough what it happened last year. So only driver left for India is either currency, dividend or earnings. Earnings was also missing. So let's suppose if earnings make a comeback at a 12, 15 or 13% handle, that's the short return you will get. On top of it, even if the relationship remain on the sideline, you can expect zero valuation re-rating. But in case if relationship get marginally better, 5%, fully better, maybe 15% re-rating you will enjoy. So that's the difference between base and bull case will be. But encouraging part is, as you can see for the past few days, talks have again started happening between the PMs and the presidents overall. We have seen in month of October the defense deal was being done and people are warming up to it. So you can say as a base case, the first line of post you want the 25% penalty tariff that was imposed on India for Russian oil import. That needs to come down because India's Russian oil import has come down. So if that tariff goes away, market will start pricing. Things are moving towards much more better level.
Okay, Rajiv, I do want to stay on this target again. If the base case is at 30,000 at the moment, that's still a hefty uptick for the Nifty 50. What do you think are some of the other headwinds that can challenge that? Because while the outlook for equity seems cautiously optimistic, it's still a bit fragile, and maybe not because of what's happening in the economy, but with regards to uncertainties on the outside. What do you think are some of the bigger headwinds we have to watch out for that might pose challenges to that 30,000 call?
So obviously the biggest headwind will be what's happening in the bond market. We definitely worry about what's going through in Japanese market. Level volatility which we are seeing on Japanese yen or Japanese government bond deal. Japan has been one of the biggest funding currency, and that has not just benefited US, it has benefited rest of the world also. So any gyrations coming through that will also lead to a rollover in the risky asset also. India could be definitely one of them. Relative relatively they outperform, but absolute term it will be struggle. Then coming to the point of AI, again, when we talk about being neutral on AI, we talk about consolidation. We don't talk about crash or a big correction. If rollover is happening at such a furious pace, then definitely all bullish bets are off the table on global equities, because we have seen in the past when the dot-com bubble burst happened, if it's a risk-off scenario, you will not take your money from one equity asset class and put into other. You will say, my first stop is go on cash. And as you take the cash call, other markets will also struggle. So relative term, it will be a good situation for India, but absolute term, still you will not be able to make money if all this scenario pans out, be it on AI or be it the ongoing volatility in Japanese market.
And again, if we needed another reason as to why the BOJ's decision this coming Friday is going to be very important. Thank you for outlining that. Rajiv Batra from JP Morgan. Always appreciate you stepping into the studio with us, and we'll see if these bull and base cases do hold in the year to come. Appreciate the time, sir.
Thank you. Thank you.
Well, Indian markets have just joined the trading day about a minute and change into the Monday session, showing some weakness at the open. We'll take a closer look after this short break. Back in 2. Welcome back. And about 3 minutes into the trading session out in India, we take a look at how the Nifty 50 is doing, and not too hot for the Mumbai benchmark today. It seems that breach of 26,000 was short-lived, currently at 25,958 points. Well, it's been a rather moody and somber Monday, not just for India, but regional markets across the Asia-Pacific. The Indian rupee also looking a bit firmer in today's session, but not by much. 90.51 is where the local currency stands against that U.S. dollar that took a little bit of a step back and a little bit of softness over the last 24 hours. But the rupee still in danger or at risk of testing a new record weakness against this ever important U.S. dollar. We'll take a look at shares of Indigo's operator Interglobe Aviation and signs that the stock is indeed seeing some slight recovery so far this Monday, up by about 0.75% at 4,895 rupees per share. The airline says it expects to pay out about $55 million to passengers affected by last week's mass flight cancellations. The airline scrapped about 4,500 flights after poor pilot roster planning, stranding tens of thousands of travelers and prompting India's aviation regulator to impose a 10% cut to its winter schedule. Indigo says compensation will go to customers whose flights were cancelled within 24 hours of departure or who were severely stranded at airports between December 3 and 5. The disruption has already forced the carrier to lower its capacity and revenue outlook for the current quarter. Meanwhile, Novo Nordisk has launched its blockbuster diabetes drug Ozempic in India, pricing it at about $24 a week as it targets the country's rapidly growing diabetes and obesity market. The drug will be sold in 3 doses, with monthly prices ranging from roughly 8,800 to 11,175 rupees. Analysts say these prices will likely set the benchmark for cheaper generics expected as early as next quarter. India has the world's second largest population of type 2 diabetes patients, making it a key battleground for weight loss and metabolic drugs. Novo Nordisk faces rising competition from Eli Lilly and Indian generic drug makers ahead of Ozempic's patent expiry in 2026. We're joined now on the phone to talk more about this by Vishal Manchanda, who's an analyst at Systematics Institutional Equities. And Vishal, very, very interesting and very important developments with regards to the pharmaceutical and drug space out in India. Just how big is this? At a $24 a week, is the pricing competitive given the fact that there are other players already in this fast-growing metabolic drug space in India?
Yeah, hi. So I think the market opportunity is clearly very large in India, looking at the population. So in my estimate, we have about 50 million patients who are on diabetes treatment in India. So if I just assume only kind of 5% of those would take a GLP-1 at these prices, $24 a week, there is a very large opportunity for the company. But then we'll see the prices coming down as generics enter in the next quarter. So I think the price point as of now is lower than what Mounjaro is at, the other competitor in the therapy. But it's still higher than what chronic drugs are priced in India. So it's probably a price point we have not seen earlier for chronic medication. This is still higher than what typically we see prices for chronic indications in India.
Okay, Vishal, could you talk to us about how price-sensitive Indian consumers are in this particular space, in the weight loss and metabolic drug space? Because you mentioned it's still slightly higher than some of the generics that already exist in the Indian market. Just how sensitive how price-sensitive are Indian consumers in this space, and what does that mean for Novo Nordisk's own entry or Ozempic's own pricing in the future?
So it's not only higher than the generic medications that sell in India, but it's also higher than what patented medicines have been priced for chronic conditions in the past. So this is still a higher price point. So I think I don't get your other question. What was the other question?
Oh, just asking you about how price-sensitive this particular market is, actually, because as we mentioned, it is slightly higher than some of the others. Yeah. So just want to get an idea of how price-sensitive consumers in this space are.
We have seen quite a lot of price sensitivity in the past. Especially for diabetes, when prices have come down, volumes have typically grown 10-fold, 12-fold from what they were prior to so whenever patented medicines have been ready. So whenever prices have been cut on patented medicines, volumes tend to grow 5-fold, 10-fold depending on the extent of price cut. So if probably prices come down almost half of what they are today, we'll see volumes growing 3-fold from what they would be at this price.
Okay, Vishal, just quickly, what are you expecting after March when some of these patents actually expire? I'm assuming this opens the floodgates for more generics and more products to come in. Just how competitive might the landscape be after that, and would we expect that the price set by Novo Nordisk come down even further?
So in my sense, we'll see kind of very intense competition. What I can see in India is almost 10 to 15 companies have been doing clinical trials to launch a copy of semaglutide. So if all of them get an approval, it will be a very competitive market. And in my sense, it can still come down, say, 60 to 80%. If all of these players get into the market, we can see prices 60 to 80% lower than what they are today. And probably Novo would match the prices.
But at 60 to 80% lower than where we are today, is it still profitable or lucrative for a company like Novo Nordisk to stay in? And can they maintain a decent margins to keep them in there as well, Vishal? Just quickly.
So Novo has historically been very competitive to generics. So they have their insulin portfolio in India and they've priced it very competitively. So I think they can also do that in case of GLP-1, and it will be a profitable opportunity even at those prices.
All right. Vishal Manchanda from Systematics Institutional Equities, thank you for joining us today on Inside India and providing us more color with regards to these big moves made by Novo Nordisk in the fast-growing weight loss and metabolic drug space out in India. Well, soccer fans in India were delighted over the weekend with Lionel Messi warmly welcomed by fans at Mumbai's Wankhede Stadium as part of his GOAT India tour. Messi was joined on the pitch by Inter Miami teammates Rodrigo de Paul and Luis Suarez, delighting the crowd with passing drills and souvenirs. Cricket legend Sachin Tendulkar and other celebrities were also in attendance, with the tour's first stop in Kolkata on Saturday, coming out relatively chaotic, with fans storming the pitch and damaging seats after Messi's brief appearance. Well, that's all the time we have today on Inside India, but do keep watching CNBC because Access Middle East is up next. Have a good morning.